Today, I'm going to walk you through why I think Phoenix might not be as hot as other people are saying. Let's get started. Welcome back. Okay, so Phoenix, Arizona. Amazing place. Scottsdale's fantastic. It's really picking up. There's a lot of new development. People are moving there. It's a big beneficiary of the COVID migration from California, New York, and Chicago. But something tells me that maybe there's something beneath all of that doesn't shine so well to a massive appreciation rate. So I'm going to walk you through some of the things that I see happening and what my forecast is for this market, okay? Now, as I always say, this is my opinion. Yeah, you should always do your own research, but understand that I go about this by analyzing a number of variables, dozens of variables. I analyze what developers are doing. I understand what the economic councils are approving for developments. I look about all different ways and variables to understand, does my math make sense? Okay. And so we'll go through a few of these things right now. And by the way, if you don't mind, please subscribe. I do all this work for you all, and it takes a lot of energy. And you subscribing to my channel allows me to keep going. All right. So, okay. Phoenix, Arizona, population, 4.9 million people, really large. Back in 2000, it was 3.3 million. That's an annual compound annual growth rate, or a CAGR, as I like to say, of a 2.2%, right? So faster than the national average from a population standpoint. That is one thing that we'd love to see, is we like to see faster than the national average population growth rate, okay? Median income, we also like to see that grow faster than the national average. However, it was around $47,000 for median income in 2000. It's around $69,000 today. That's around a 2% CAGR. Not bad. I do like to see around 3+% on that. The city GDP, now this one's pretty gangbusters. This city has grown at a clip of almost 5% annually for 20 years. That is a massive GDP growth rate. And I think what we'll go over here in the next few minutes, you'll see that there are a number of factors that really makes Phoenix an attractive market long term. And if you stick around to the end of the video, I'm going to give you the two top areas that I see the most development happening, so that you can maximize your profits and take advantage of this opportunity. So we also want to look at average home price. Now, Phoenix during the crash, if you recall, was a market hit pretty bad, right? And it's had a relatively volatile real estate market. And I think partly due to the fact that the economy wasn't that diverse. I always talk about in my videos that one of the key factors I want to see in a market that I'm picking is a diverse economy. You don't want to have one major economy, such as like what Detroit had, which was auto, then everything goes to India or China, only to see a massive reduction in GDP. Okay, I think Phoenix will be set up long term for a more diverse economy, and I think it's becoming more of a stable, economic powerhouse long term. So another one. So average home price back in 2000, we're looking at $175,000 average home price. At the peak of the crash, it was $256,000. Today, it's $366,000. So definitely a rather fast increase. That's about a 4% appreciation rate annually for the last 20 years. So again, we know that our foundation appreciation rate of Phoenix is around 4%, right? And if you recall in my other videos, I mentioned this, the NAR, or the National Association of Realtors, on average, real estate has appreciated at 4.3% annually. So the foundation of appreciation in Phoenix is right around the average. So that's a good sign as well. New home permits, simply supply and demand continues to be a tailwind for price appreciation in real estate. You're seeing permits happening in Phoenix, but you're seeing the demand skyrocket in that market, and there's no signs of it slowing. Today, the months of inventory. Now, keep in mind, 6 months of inventory is a balanced market, right? So if you built no more homes, or if no more homes in the market came onto the market, there were 6 months of inventory. That is a balanced seller-buyer market. Well, today in Phoenix, you have about a month worth. So there's simply just no inventory. And if you look at what's been happening in the past 12 months, like any hot market, Phoenix is seeing massive appreciation, right? Just like Austin, just like Dallas. And if one of the things that's caused, or is causing that, is the population migration from California, New York, Chicago. And if you look at the top 3 markets that are experiencing the most amount of population growth because of COVID, Dallas number one, surprisingly. Austin, Phoenix go back and forth between number 2 and 3, right? So you're having the most amount of people move to these already saturated markets full of demand, causing more demand on real estate. So, but what's interesting about Phoenix that is not as attractive is when you put it all into perspective. And this is what I talk about. It's great to have numbers, appreciation on price. What you got to factor in is, what does it all mean relative to the affordability, right? Because if people can't afford a payment, they're not going to end up paying a certain price, right? The price is really dictated upon what people are willing to pay for something, okay? And so we have evidence from 2000, the crash, 2010, that people in Phoenix tend to spend about a third of their income on their home, okay? Well, today they're spending about 27%. Now, if that's one of our key parameters, right, then I think just on that alone, people would be willing to spend at today's cost of a mortgage, which is around 3.5%. They'd be willing to spend up to $425, $450 as the average home price in Phoenix. Okay, now that is a 23% appreciation rate over a 3-year period. So again, what I'm saying is, I think if all the macro indicators are strong, which they are, and I'll go over a few of these in a second, and the growth is still there, population is still growing at a fast clip, faster than permits are being developed, then there's no reason that people won't end up paying what is relatively affordable. And affordable in Arizona, I think will go up to around $425, $450, and then probably level off at a much slower rate, 3-4% annually. So what that means is, I expect in 2021 around a 10% appreciation rate. And by the way, these are all single family homes, not condos, not multifamily. We talk about single family on these forecasts. So around a 10% clip in 2021. I expect around a 6 to 8% in 2022, as well as 2023. That gets you to around a 23% appreciation, which for a top 3 market of population migration, while it's attractive, it's nothing close to the Austin or the Dallas metro. And that's what's been shocking, is that the price has already grown so much in Phoenix that there's not a ton of upside. There is some upside, right? But the upside is also not driven by a ton of high-paying jobs. So the question becomes, well, that median income's got to shoot up fast too, which is often done by tech jobs and high-wage jobs. The jobs that are being created are focused in a few areas. One's going to be advanced manufacturing. Boeing has a plan to build a massive plant there in Q3 of 2021, so this year. You have Amazon in their robotics department is going to be developing some jobs there too. So when you look at what's happening from a job standpoint, Phoenix is definitely attracting jobs. It's just not the highest paying jobs, right? It's not the 6-figure jobs that are going to drive prices to $600,000 for a house. It's the jobs that are good jobs that will afford people to be able to spend $350, $450 on a house, as long as debt remains as what it is, right? Now, keep in mind too, property tax in Phoenix is only about, it's less than 1%. So it's pretty affordable from a property standpoint to own in Phoenix, okay? So, and again, I'm going to give you the 2 neighborhoods that are really going gangbusters and seeing a lot of the development, right? But when you look across Phoenix, it's really not a hub that's creating very high-end jobs. And so I think there's definitely a ceiling on how far these prices can go. And I do think $425, $450 as the average sale price in Phoenix is probably the ceiling, and then it'll flatten out to a more usual rate of around a 4%. So what that means is appreciation, absolutely. Demand, continued demand, absolutely. Are we going to see prices go $500,000, $700,000 like we're seeing in Austin? I don't think so. I think we're going to see around a 20 to 25% appreciation over 3 years. So where are the 2 best neighborhoods? Well, or more like areas, if you will. So I own land in Arizona. I own 80 acres that I'm developing, my own subdivision, as well as a resort. And so I'm in Phoenix in Arizona quite a bit, right? Every 2 weeks or so to check out what's going on. And I visited recently Glendale. Now, Glendale is out by the Cardinal Stadium. And there's something there called Topgolf. And if you don't know what Topgolf is essentially a virtual golfing, arcade place, right? And I was curious about Topgolf, what it costs to develop one of those places. And you might not be surprised, or you might be surprised. The Topgolf in Las Vegas cost $50 million to develop. Okay. The average Topgolf location costs anywhere between $10 to $15 million to develop. Now, these are massive, facilities. These are big investors who are buying these places and developing them and taking a massive risk, right? Now, these people also have teams that research and analyze the market data. I say this because if you follow the money when it comes to development, you can figure out if it's a good idea to be investing in that area. Well, Glendale is an area with a Topgolf, and it's with the view of the Cardinal Stadium, right? And if you look at what's happening there, you're seeing a lot of development in Glendale with all sorts of manufacturing, advanced manufacturing, and price points are still fairly affordable in that market, right? And so I actually think Glendale, which is just outside of Phoenix, about 30 minutes or so, has a lot of room to grow and will probably be better than the appreciation rate that I just mentioned. And the other one is Goodyear. I mean, Goodyear is an area, around Phoenix as well that is going bananas. This is where Amazon is putting their new facilities. This is where they're building out the robotics center. This is also, there's a Chinese mattress manufacturer that's going to bring a massive amount of jobs for that. There's a lot of unique manufacturing happening there as well. And so I think Goodyear, just similar to Glendale, is set up quite nicely for appreciation, right? So these two could be good markets for rentals. I think Phoenix proper might be, I'm sure there are pockets in the city, but generally I think you'll have more stability, a better tenant class, and ultimately more upside in the two areas that I just mentioned. So again, I'm estimating around a 20 to 25% appreciation rate over 3 years for the county of Maricopa in total. Obviously, it'll fluctuate depending on where you're at. I would love to know what you think. Put your comments below and give me some clues or some tips as to where you're investing or how you're investing in Phoenix to take advantage of the appreciation forecast in the future. So thanks for watching.